Hi guys, and welcome to our podcast. Today we're going to review the most common mistakes made by investors. If somebody came up to me and said they don't make mistakes when investing, I would probably have a big smile. Mistakes are inevitable when investing. Out of every investing book, website, plan, or anything else, we still do not have a perfect algorithm on how to invest flawlessly all the time. Investing is a gamble, and everything should be recognized as a gamble, no matter the odds. Even more, investing is such an emotional and mental drain, especially when you have been in the market for a long time and the money is either not what you expected or you are quickly losing. A lot of the times, these mistakes made by investors occur more than once. Most investors have actually been making the same mistakes for a long time now. These mistakes can go all the way back to when the markets first opened. Unfortunately, most of these mistakes made in the past and present will be carried out in the future. The first step in understanding these mistakes is to actually know about them and acknowledge them. Then, apply them to your investment strategy and gain. Enough talking about that. Let's dive right into it. The first mistake you can do is not understanding what you purchase. Warren Buffett and loads of other veterans in the stock market claim that buying shares of something you don't quite understand is a good way to fall on your sword. Part of the reason Ashton Kutcher does pretty well at funding technology companies and startups is because he understands and appreciates technology. So to make it clear, you should not invest in a company if you don't understand and get their business plans and models. A good idea and a smart way to avoid this is by establishing a portfolio that varies with exchange-traded funds or by mutual funds. Choosing to purchase stocks in a specific company can be rewarding, but only if you understand the company and their business plan and market. The second thing is to make sure you're not too eager. When investing, patience is about as essential as it gets. At the same time, when you make decisions with the wrong frame of mind or with eagerness, you are destined to get a lot of problems. One thing that puts few investors ahead of others is knowing that you won't make a fortune overnight, and you cannot expect to be 100% profitable instantly. Investing, along with a lot of other aspects of life, doesn't always plan out like you want it to. Even diamonds are dirty when they're first pulled out. If you made a list of essentials for investing, patience should be one of the first things. There are a lot of cases when a stock invested in seems to be dull and not worth it at first, but after a while became very valuable. And just think, this is not a rare occurrence. It happens a lot. So don't feel awful or sick when you know an investment you made was a good one but doesn't look amazing at first. Hold on. Let the cycle of a manager's strategy plan follow through before you get upset. These cycles can go on for a long or little amount of time. Take, for example, recessions. We don't really identify a situation as a recession until after it happens. The old story of the turtle and the hare racing still applies. A progressive return might be slow, but it will no doubt beat out any of the irrational decisions made in a wrong frame of mind. Keeping our eye on the prize and having realistic goals for our portfolios and strategies will be more beneficial than expecting magic or luck to happen. A good plan is very important, and therefore bad planning/no planning is one of the most common investor mistakes. Not knowing your plans and where you want to go is about as bad as shooting yourself in the foot. Here's how we can fix this. Make a plan that identifies the list below. Future plans. What do you plan to do? Have an excess of retirement funds, or maybe even save up enough money to own your own business in later years? Risks. Do you think you're a conservative investor, moderate, or aggressive investor? If you're planning on saving for retirement, being an aggressive investor is probably not the best approach. In each of the cases, you can choose your own preference. Investing in defensive stocks, conservative investor, dividend stocks, moderate, or blue chip stocks if you're attracted to risks. Successes. You need to define what you think is a job well done, or what is not good enough. These help to reward yourself and keep you on track. Distribution of money. Where does your money go? Which market? What stocks? Or maybe considering alternative investments is the right thing to do. Making sure you know where your money is going and what all you want and need to put your money in is critical. Make sure if you do percentages, which percent goes where. Knowing where to put your money is a critical part. The asset allocation helps astronomically. Dispersion. Don't stick to one category within a subject. Make sure your money is diversified among different categories. A good plan is almost like insurance for yourself by clearly identifying your strategy, which is a savior for when the market is not so good. Remember, keep your future plans in mind. Don't have the mind of a day trader, and if you do, better to start with some technical analysis articles before. You're an investor looking to increase your wealth for any number of reasons, not trying to guess the market to keep your head above water. Think long term. The next thing you shouldn't do is fall in love with a company. Just because a stock provided good returns earlier does not mean you should feel an emotional connection to buy it. Keep the emotions out of the markets. If you buy an investment, it shoots up 30% and you feel amazing, that's great. However, that doesn't mean you should instantly look at that stock every time you want to invest. Most of the time, you end up getting yourself beat when you have an emotional approach. Always remember why you purchase stocks: to make money consistently. Once you identify this problem, your returns and strategy will skyrocket upward, making you more successful. Another popular mistake is new investor willingness to jump the gun. A lot of times, people get way too eager and feel like they need to constantly change their positions and rethink their strategy. If something changes, somebody tells them differently, they hear the news, or anything else, they're not patient enough to stick through and believe in themselves and their strategy. Aside from the problem of denying your strategy, you also can have a pretty hefty bill in the end due to processing fees and other payments taken from the brokerage. Also, when taxes come around, this can be a huge headache. What's the point of gaining profit if you're just going to have to pay off all your transaction fees, excluding taxes in this scenario, and giving your well thought strategy a kick in the shin from all of these payments? Nothing. It's pointless. It's basically, as the expression goes, 6 up and half a dozen down. Now, if we do include the taxes in the scenario, can you imagine the headache you would have sorting that out? All of the transactions from buying and selling all different types of stocks and other investments doing taxes? No thank you. Save your future self a headache and some time by taking it easy, not being too eager, and just let your strategy do its thing. Let's keep the markets black and white. Don't let your fears and opinions and feelings, how long you hold on to it, how you think about it, etc. Try your best to think rationally. It is human nature to try to justify a bad decision made. Imagine if a photographer bought a Nikon DSLR. Then the next day, they bought the equivalent of the Nikon DSLR in a Canon form. If one camera outperforms the other in something, the photographer might think, I knew this would happen. I'm so glad I made the investment in both. But if they are equal in performance, the photographer might think, I knew these cameras were the same, and there was no point in buying both. Don't try to justify your reactions. Use your strategy. Let it work according to the plan. Stay calm and stay positive. Another aspect you should clear before you start investing is your expectations. This one's hard. We think about saving, providing, paying bills, buying a few of those once, and we invest. Shouldn't everything line up and our investments pay off? Well, no. Investing won't make us rich overnight. We're especially let down when we aren't rich even after managers of our investments promised outsized returns. You can't win everything. You probably won't be the next hedge fund manager news companies ask about for stock picks. However, keeping the end goal in mind and not having expectations above and beyond will definitely help you. Don't listen to the hype about some penny stock that soars up in value, or any person on the internet that claims to be above everybody else. Keep it real. The last common mistake is rely on recommendations by friends and coworkers. Hey, I'm looking for some good stocks to invest in. You know of any? Well, blank seems to be doing well for me. Also, blank. Oh, okay, thanks. Let me go check that out. Then you go to check it out and find out you complete your order based on the sole reason your friend has shares in it. This strategy is not so good. While it isn't bad every single time, the majority of the time, these don't play out well. You have a friend that knows a lot about stocks? Awesome. Collaborate. Just don't listen to everything this person says and buy shares with blind eyes. Investing should be done thoroughly, not just scratching the surface. Bottom line, these simple mistakes can be acknowledged fairly easily, but a lot of the time we forget the basics. It's not the end of the world. Realizing your mistakes now can greatly impact your decisions in the future. Identifying and fixing these will cause your returns to increase dramatically. And isn't that the whole point of investing? That's it for now. On our website you can find more posts as well as investment calculators and other financial tools. I hope you enjoyed it, and don't forget to subscribe to our podcast channel on YouTube. We would love to learn from your mistakes, so feel free to share them in the comments below.